Well, Happy New Year to everybody. My name is Eric Fox, Chief Economist at Veros Real Estate Solutions, and I'm joined today by Rina Agarwal. We'd like to welcome you to our very first webcast for RiskWire for 2026. So we thought today we would take a look at one of the topics that we've seen in the news related to housing that seems to be on a lot of the headlines these days. So we thought we'd just address both topics in the webcast today. So the very first one is there are two policy proposals. Now, as you all know, Rina and I, we're not political. We're not saying these things are definitely going to happen. We're not saying these things, if they do happen, this is how they will be deployed, whether they'll be successful or not. But what we're trying to say is if these proposals come to pass, what is the likely economic impact of those proposals going to be? So the first one, I think we've heard a lot about limitations. The president has proposed limiting institutional investors, very large investors in real estate, from purchasing additional such homes in 2026 and beyond. So the thinking is they're not going to make them sell the existing inventory, but only to bar institutional investors of a certain size or larger from purchasing new homes. So that's the first one. The second one is to have the federal government purchase $200 billion in mortgage-backed securities. I think we've heard that one most recently. So both of those have the goal of easing affordability pressures. And I think we all can see the path for each of those to making things more affordable for potential new home buyers. So those are the questions I think we'd like to tackle today. So maybe we can start and investigate.
Yeah, I think that's a very good idea. I think the idea behind, like you said, these two proposals is to ease affordability for many first-time home buyers. But the real question is, will this really move the needle? Will these proposals make a significant impact on the ground in the housing market for home buyers? Or will the impact just be incremental? So this is what we are going to discuss today. And why are we even talking about affordability? Why are we talking about these proposals? I mean, we've been talking about this for a while. Home prices since the pandemic have gone up by 40%, 50%, even more than 60% in some metros. Mortgage rates have increased from 3% way back in 2021 to more than 6% now. So mortgage rates are high, home prices are high. Income growth has not caught up with home price growth. So as a result, many folks are not able to buy a house. And that is what has led to this kind of frozen or stuck housing market that we've been talking about over the past 2 years. So the aim of these proposals is to help ease these affordability concerns.
So maybe let's talk about the very first one, and that would be the institutional investor ban from purchasing housing. And so that proposal clearly targets demand by focusing on who can purchase a home. So presumably, the thought process is if we ban this certain group of individuals, these certain corporations or large purchasers of home from buying homes, that then reduces overall demand for homes, doesn't crowd out folks like you and me who want to buy a home. And presumably that would, the less competition would mean prices would be a little bit lower, or at least not as increasing as aggressively. So I think first we have to really think about what is large. Again, in the beginning, we said we really don't quite know what the policy, actual policy would be. Does large mean an institution that owns 100 or more homes, 1,000 and more homes? Honestly, we don't know exactly. But for talking purposes here today, I think what we're going to define as this large institutional investor would be 100 homes or more. And if we look at that, these very large or very large homeowners currently today own about 80,000 homes in the United States. And that's about 3.4% of all rental properties in the United States. So that's current ownership. But if we look at the rates that they are acquiring homes, if we just look at recent history, say during 2025, we see that that number is only 2%. So it seems that these institutional investors are purchasing fewer homes than perhaps they have historically, even as recently as 1 year ago. So even if all of that demand went away tomorrow because this policy was implemented, around the U.S., it would likely impact about 2% of the demand.
And also, when we're talking about across the U.S., it may be 2%, but there are certain neighborhoods or certain metros where we feel that investor presence is much more. And this is because during the pandemic or during the 2008 housing crash, investor activity really increased in some Sunbelt metros. So here investors bought a lot of houses. For example, if you look at Memphis, 4.6% of the total stock of single-family homes in that metro are owned by investors. Similarly, if you look at Atlanta, 4.2% of all homes are owned by investors. And I can give more numbers. Charlotte, North Carolina, the share of investors is 3.8%. In Phoenix, it's 2.7%. So yes, probably in these metros, the investor presence is much higher compared to the national average. But like you pointed out, this ban is not going after existing homes that are owned by investors. This ban is only going after future purchases, as far as I understand. So even though in these metros, investor presence is really high, it's not going to impact the current ownership or the current stock of investors we have right now. So even if this ban were implemented, in my opinion, the impact would be incremental. It would not be very dramatic.
And I agree with you, Rena. I mean, I think if we look at the range of numbers that we've just given there nationwide, being on average about 2%, and the highest for any metro area for investor-owned properties being around 5% or just under 5%. And then if we say that would cause demand to reduce by 5%, and then we start doing our calculations as to, well, how is that going to impact house prices? The answer is not really very much at all. I mean, when we talk about supply of homes on the market, demand, and if it's shifting and changing, we look at numbers like, is it going up 25%, 50%? Is it going to double? That moves the needle clearly. When we're talking 5% at most, 2% on average, that unfortunately just doesn't really move the needle too much. And if it does move the needle, it's probably going to be at best 1% or 2% in house price softening in a given market.
So what we are saying really is that this ban is not going to suddenly free up millions of homes across the US that home buyers could buy. Neither is it addressing this huge supply problem that we have, because it's not going to increase the actual stock of homes in the country. So here is the limitation about this ban. It will definitely curtail demand to some extent, but it's not going to increase the supply that we have in the country.
I agree with that, Rena. So with those comments, the other thing to keep in mind, which is really very surprising, although these mega investors, institutional investors, do own large numbers of homes, there aren't large numbers of them. If we look at who owns, what kind of individual owns these investment properties, it's people like you and me. And how many do they own? Well, we don't own hundreds and thousands. We own 2 or 3, 1 to 5. And when we look at who owns 1 to 5 investment properties, that's 85%. So we're essentially saying 85% and then some more than that are less than 100 homes owned, and they're off the table for this. So it really is a fairly small percentage, given it's not really meant to impact existing homes. Now, if it was to leak into that and include some existing homes that they were forced to sell, which again, we hear that that's not the case, then that could be a different story.
Yeah.
But as it's proposed, we don't really see much of an impact.
So let's talk about the second proposal. The second proposal involves that the federal government buy $200 billion worth of mortgage-backed securities. So this proposal intends to work through a different channel. While the first proposal was going to restrict demand, this proposal intends to lower the borrowing costs or financing costs, because if the government buys up $200 billion worth of mortgage-backed securities, this increases the demand for such bonds. What that does is it lowers their yield. And when that happens, then there is a corresponding decrease in mortgage rates. So now the real question is, how much will mortgage rates decline? What will be the impact again here?
Now, 200 billion sounds like a lot to me, Rena.
Yes.
Now, before, when we're talking about homes and 2% and all that, it didn't sound like a lot, but 200 billion does sound a lot. So could you maybe shed some light for us on how 200 billion, is that a big number?
Well, 200 billion on its own is a huge number. But when you compare it to the total worth of mortgage-backed securities that are outstanding in the US, that is $9 trillion. So if you compare that just $200 billion is just over 2% of that amount.
Okay.
And we have seen this before. During the pandemic, again, the Federal Reserve bought they at that time they bought around $900 billion worth of mortgage-backed securities. So, but the other difference between then and now is, at that time, mortgage rates were already lower than 4%. Right now, mortgage rates are above 6%. So even though at that time, yes, mortgage rates did go down to 2.67%, but we don't anticipate such a large impact right now. We don't think mortgage rates are going to go that lower. They're probably going to decline by 15 basis points to 30 basis points at the most. So maybe we'll end up just shade under 6%, but not too much.
So the rationale here is, if back during COVID times, they purchased $900 billion in mortgage-backed securities, and rates essentially went from 4% to 3%.
Yeah.
And now we're talking about $200 billion, the proposal anyway, but we're sitting at a little over 6%. So your estimation is around 15 to 30 basis points reduction.
And also there is another layer to this. Mortgage rates just don't depend on government actions. They also depend on the treasury yield. They depend on the inflationary expectations. They depend on what is happening in the global capital markets. So mortgage rates depend on the wider economic forces playing out. So we can't just think that, $200 billion would translate into a huge dip in rates.
Well, now, Rena, what would happen if all of a sudden rates were, let's just say 5.7% or 5.8%, to your point a minute ago? Wouldn't that potentially stimulate demand? And what would happen then?
Yeah, well, you know what happened during the pandemic. Rates went down, demand shot up. And if supply has not increased in the same moment, for somehow, then we are going to again see home prices go up. And then it just cancels out that whole affordability issue that we are trying to solve here, right? If home prices go up, that will cancel out any beneficial impact of the decline in rates. So again, we think that here the impact would be marginal. It's not going to be dramatic. So that's...
or it could be just the opposite of what we hoped.
Yes, it could just be the opposite.
So when you put these two ideas side by side, it looks like they're trying to solve the same problem, but in two different ways. The investor ban aims to reduce demand, and the mortgage bond purchases aim to reduce the lower cost of mortgages. But kind of what we're coming to the conclusion of, it sounds like, is that neither one by itself or even when combined with each other seems like it's going to do much more than a marginal effect in most markets, and we're not looking at any dramatic impacts overall to the U.S. housing market.
That's exactly right. And the main reason is because neither of these proposals is addressing the key issue in the housing market right now, that is supply. And unless that supply increases, especially in the low price tiers, affordable housing or entry-level housing, we are not going to see any major shift in the housing market, given the current conditions.
Okay. Now, should we say that these proposals then have no merit whatsoever?
No, I'm not going to say these proposals have no merit. I'm sure there'll be some buyers who are going to benefit from the slightly lower mortgage rates. There's some buyers who are going to benefit from that reduced competition from institutional investors. So yes, and especially because institutional investors are more active in the low price tiers where entry-level buyers are going, that might help some people buy homes. So we cannot say that both these proposals are going to be just like a nothing out there. So let's hope that some folks benefit from it.
Okay. Well, very interesting discussion today. Sometimes when you see the headline splash across the Wall Street Journal and you start digging in, you come up with maybe some interesting different conclusions. Well, thank you again for joining us today. Again, my name is Eric Fox.
I am Reena Agrawal, Senior Research Economist at Veros, and you can find us on Apple as well as on Spotify. See you next time.